good morning to all of you. Me and Septima are going to take you through the financial and operational results for the second quarter in our financial year 24. We are going to follow a normal program, giving you the highlights before moving into more granularity of the three business areas that we have in order for you to understand what has been achieved there. Septima is going to go a little bit deeper into the financials before we share our view on the outlooks for the rest of the year. And as Hannah says, there is an opportunity to ask us questions. Focus in this presentation will be Q2, but for the benefit of our UK shareholders, which tends to focus more on the half-year point. We will also cover how we are looking, having left the first 6 months of the year behind us. Let me start with highlights of the quarter, which, as usual, I must say, has been a busy one for the whole Benchmark organization. Besides running and optimizing the business, which is really the main thing for us as a management, and which we always do, we are, as Hannah also mentioned, in a strategic review process. And for those of you who hope to have comments on this process, I will have to disappoint you. It will be no comment further today on the strategic review that we announced back in January. So moving on to summarize the highlights in a quarter where we have been able to gain momentum compared to the last 3 quarters. Despite the fact that we have had significant forex headwinds, as well as some headwinds in some of our main markets. We have delivered well in the quarter and to our expectations in the 2 main business areas, genetics and nutrition, at the same time that we have continued to transit to a less capitally intensive business model in our 3rd business area, health. In terms of numbers, Q2 revenues ended at 39.8 million, which in constant exchange rate is slightly down, more or less flat compared to what we delivered in Q2 last year. As pointed out in what I just said, our performance was driven by strong performance in genetics and advanced nutrition, both areas experiencing growth compared to last year's second quarter, measured in constant exchange rate. This was again offset by a reduction in the revenues in health as a consequence of the transition that we have been in to a less capital intensive business model in this area. In fact, we have taken out one of the assets that we had for Ectosan Vet and CleanTreat in the health area, removing both exposure but also the revenues of that asset in this Q2 compared to what we had 1 year ago. Looking at our adjusted EBITDA, excluding fair value movements, and this is the measure that we consistently have used now for quite some time, because we think it's the best measure to fairly reflect the underlying business. We see a strong performance with 9% growth year-over-year, measured in constant exchange rate. The strong overall performance in Q2 is also reflected in our overall adjusted EBITDA margin, ending at 25%, which is in line with the medium-term target that we have communicated for the group. The group margin is, of course, built on very solid margins in all our 3 business areas. Strong operational performance in the quarter is also reflected in our adjusted operating profit, excluding fair value for the quarter, ending at 5.9 million, a growth of 24% compared to the second quarter last year. Our balance sheet remains strong with cash of 20.8 million and available liquidity at 40.5 million. I will leave it up to Septima to take you more in detail through our balance sheet. On the bottom line, we see an improvement quarter-over-quarter compared to last year, but it is still negative as we still carry the burden of large amortizations on the M&A activity that was done, forming the group back in the time. The gap between the improving operational results, and we have seen considerable improvement in the operational results during the last 3-4 years, nearly a tripling of those. The gap between that and the bottom line will eventually go away when this amortization is ending, and that is in 2027. All in all, the performance in the quarter underpins our view that we are on track to deliver according to the previously announced outlook for the full year. Then, moving over to give more granularity on the performance of the different business areas, and starting with genetics, where we landed a strong quarter with solid performance in the core business and good progress in our growth vectors. This is also reflected in our numbers. Revenues for the genetics area are up both in nominal numbers, +2%, and even more so in constant exchange rate. This is driven by revenues from salmon egg sales, which is the core of this business area, but also good progress in our growth vectors, especially Chile, and increased harvest income. The adjusted EBITDA, excluding fair value, ended significantly up compared to last year's second quarter, growing to 3.1 million from 2.2 million, also lifting the adjusted EBITDA margin from 17% to 24% in the quarter. This is again the consequence of improved performance in the growth vectors, and I will come back to them. Stronger harvest income, as well as good contribution from our joint venture with SalMar Genetics, which is now starting to deliver results as it should normalized do. On the top of this, we also see effects of good cost control in the quarter. Looking at the first half, having the first half perspective, we see that we, on the group level, still lag a little bit behind the revenues for the first half of financial year 2023. Again, this relates back to the particular circumstance we had in genetics back in the first quarter last year, when we benefited from the supply constraint by our main competitor in the market. And as we have said before, we did not expect that to repeat this year, and it has not repeated this year. So that leaves us with revenues that reflects more a normalized performance and progress. While lagging behind for the first half year on the revenues, we are ahead when it comes to the adjusted EBITDA in the same period. The adjusted EBITDA margin is significantly up from 18% to 23% for genetics, reflecting good progress again in our growth vectors, strong or normalized good contribution from our joint venture with SalMar, as well as good cost control. Talking about the growth vectors, we are in particularly happy with the excellent progress that we have been seeing in Chile, which is delivering a positive adjusted EBITDA in the quarter. This is a consequence of great work done by the team locally, supported by the wider genetics team in Benchmark. We are getting there in Chile, step by step, continuing our work to take our place in this market in a responsible way. We know we have a competitive and relevant genetics for this market, and we know that we have a very competent team in place that relates and works well with the industry in this important market. A key element in our strategy in our genetics business is to move towards a differentiation of our products, building in traits that are of great importance to the farmers, using new transformative technologies, making sure that we can differentiate and justify higher value in the genetics than we have seen up till today. I said that before. I think the value of genetics is undervalued in the market compared to what it should be and what kind of impact it has on the industry. And we would like to make a change of that. And we think it's a huge value creation potential for us within this over the coming years. This is also why we have had this deliberate strategy to strengthen our efforts to take out the potential that we see is sitting in this. As a first step on the way, we have launched new lines of salmon genetics into the market. These lines are more tailored to the specific traits valuable for the customers. And even if they do not hold the new transformative technologies that we are also on the way to develop, they represent a first step on the way to introduce further specialized value-creating genetics in the marketplace. More broad, we are also advancing our systematic effort on the more transformative genetics, both in terms of diploid sterility and gene editing. I commented more on that last time. We are following our plans to enable us to bring forward products with these technologies in the future. An area where we are closer to being in the market is products that is addressing the complex gill health disease, which is a key challenge in many salmon production regions. The program we have had on this has now been bolstered by a major new partnership funded by the Biotechnology and Biological Science Research Council in the UK. And our plan is to introduce products addressing complex gill health, a significant challenge for the industry. Our plan is to introduce those to the salmon industry during next year, financial year 25. Finally, on the main points for genetics, just to mention the incident that we had early in Q2 when we reported an isolated incident of ISA on one fish in one tank at our facility in Salten. The tank containing the affected fish was an isolated unit with a unique fish group with separate water systems and farming equipment. Since the incident, we have been working closely with the Food and Safety Authority on the issue, and we are happy now to see the outcome. We have been able to isolate the incident with no further implication than stamping out the one tank that was affected, and with no effect on our delivery capability. This really speaks to the quality of our genetics teams, but also the unique biosecure setup that we have in Salten, where the systems allows us to isolate incidents like this, and by this taking down the risk and consequences of such incidents considerably. Moving over to talk about the financial, give you a financial overview of the different parts of the genetics business as we have presenting them over the last quarter. We do that in order to be transparent and give you insight into the different elements of this business area. The financial figures for the core genetics business, which is Norway and Iceland, is reflecting a sale of eggs for this quarter, slightly below the level that we saw in Q2 last year, reflecting a normal fluctuation during the year and in between periods. You can also see the mentioned progress that we have had in Chile, nearly doubling our top line for the quarter compared to Q2 last year, which is of course a key in bringing the EBITDA to a positive 1.1 million for the quarter. Sale of shrimp genetics is slightly ahead of prior year with 0.5 million in the quarter. A key element in actions taken over the last quarters has been the integration of shrimp activities across genetics and advanced nutrition, driving commercial synergies and cost saving. We have managed to execute on this in a successful way, taking decisive steps toward combining the unique commercial network that we have within our advanced nutrition organization with the capabilities that we have in shrimp genetics in our genetics organization. The immediate effect of this is of course cost synergies, as you will see from this table. longer term, the combination will enable better market penetration and ability to combine an offering of world-leading genetics with early-stage nutrition. And this is an offering that we will be along with in the market. Finally, a few words on genetic services, which is now being carved out as a separate column in this overview. And we do this as this is an area that we are focusing on growing and expect it will generate more substantial numbers in the years to come. This is a profitable business where we now also have started offering very competitive genotyping services to clients around the world. The positive financial effects of these new products is still not showing in the top line or in the financials, but we expect it will add to the dimension of this business in the periods and years to come. The increased cost you see reflected in the quarter is a consequence of increased resources added to the business to enable execution on the other new services. Then over to Advanced Nutrition, the Advanced Nutrition business, or INVE, which is the well-known brand name of this business area in the market. Here we are again demonstrating a very strong performance in a soft market, and we keep well positioned for when the market again turns. I have repeatedly told you how proud and impressed I am with how we have been able to perform in the Advanced Nutrition business area, despite the soft shrimp market that we have experienced over a year now. Market-wise, we have been through a tough period, and the soft market conditions, in particular in the shrimp market, is continuing. Despite this, we have been able to uphold our performance in this business area, which is also reflected in our Q2. Top line is up by 10% in constant exchange rate if you compare it to the last quarter, which is first quarter of this year, and 3% if we compare it to the second quarter last year, illustrating that we have kept the momentum in the business in the last months. Again, given the market conditions we're working, we know that this is a strong performance, and those who are in the same markets surely will recognize that, and we know that they recognize this. In terms of adjusted EBITDA for the quarter, we see a slight drop compared to second quarter last year. Same time as we're upholding our adjusted EBITDA margin at 25%, which is in line with the medium-term target for this business area. Looking again at the half-year point, we see that for the first 6 months, we are lagging slightly behind on top line adjusted EBITDA compared to where we were last year. But if we are adjusting here for the forex headwinds, applying constant exchange rate, the performance is more flattish compared to what we experienced 1 year ago. Should be also mentioned that if you compare the first 6 months this year, last year we had a Q1 where we had good market conditions and we were moving into more soft market conditions in Q2. This year we have been in soft market conditions in both quarters in the first 6 months. A few more words on the market conditions. Albeit green shots of recovery that we see in different places in the market, and there are opportunities that we are agile enough and in position to take advantage of. The shrimp and marine fish markets are still soft with low demand. The fundamentals behind the situation remains the same. In the shrimp market, macroeconomic factors depress the demand for shrimp in end markets. This again trickles down the supply chain and implies less production and stocking of shrimp, which again implies less demand for our products. As of now, this includes all main markets, but it will eventually turn. When this happens, it's still difficult to predict, but it will happen. With the current organization and momentum we have in our Advanced Nutrition business, we are sure we will be well positioned to take advantage of the upturn when it comes. A positive element of the markets being what they are at the moment, soft, is that the farmers stick to what they know and to the relations that are well established. This is something that we see we are benefiting from, being a well-respected player with well-known brands in the market. And this could partly explain why we are doing well despite the challenging market conditions. It should also be mentioned that we continue our effort to develop our product portfolio to make sure technologies are added that strengthens our position as a provider of specialized products and solutions that commands high margin. This is a key in our strategy. A clear example of this is that our sale of Artemian with technologies added has grown from 40% to 60% over the last years, bringing this business away from being a commodity business. We used to sell, historically, if you go back in the years, we used to sell commodity cyst in Artemia. We are bringing it towards a highly specialized business, commanding high entry barriers, as well as high margins. Finally, over to health. The area where we have taken decisive actions to migrate the business model to become less capital intensive and right-sized, both in terms of infrastructure and organization. The final figures also reflects this, both in terms of top line as well as adjusted EBITDA, compared to what we achieved both in Q2 last year, but also if you compare the first 2.5 years. A key part of the journey we are on is to migrate the business model we have for the solution we have on Ectosan CleanTreat from a PSV-based model where CleanTreat are situated on PSVs, which has been the starting point for this operational setup. We are migrating that towards a model that is less capital intensive for us and less costly for the customer. We do this as we see from experience that the initial setup with the PSVs being operational, well functioning and delivering and proving the concept, but it's not economically viable for us given the fluctuations in demand that we have been experiencing over the first 2 years. The first step on the journey was to take out one of the PSVs early in Q2, reducing the exposure to one operational PSV available in the market. So this has been the operational situation throughout Q2. Given that we now are entering into what has been experienced as a low season for treatments during the last summers, we have had low activity levels and demand for Ectosan and CleanTreat. We are now also taking out the last PSV from the market, reducing our exposure to this initial business model to none. As explained earlier in earlier quarterly presentations, the ultimate business model we are seeking is no financial exposure for us to the CleanTreat system. The long-term solution that we have told you about for a long period is to get the CleanTreat systems integrated into future wellboats owned and operated by customers or service providers. We have done the groundwork to make this happen, and the design of such a system is in place with partnership agreements that we have with the leading wellboat equipment provider MMC, and together with them we are in the market promoting this solution as part of the new offering of wellboats in the market. We have also, and this has also been touched on in earlier quarterly presentations, we have been working on an alternative barge solution for CleanTreat that will take down the cost of the solution to the farmer. The cost of a barge is significantly lower than PSV, thus the infrastructure cost of such a solution will be significantly lower than the initial PSV setup. Here also, the technical configuration of such a solution is now developed, and we are, as we speak, reaching out in the market, talking to players about this alternative solution. Also, with this solution, our assumption is that the infrastructure investment and cost should be carried by the farmers' customers, leaving us with no exposure to the infrastructure costs. We believe a barge solution could be a good alternative to the farmers in Norway, as we see other treatment technologies also being configured on similar barge platforms now. We also believe that configuration on the barge could be an opener into other markets that are smaller than Norway, thus needs a configuration that is less in size and cost to be adaptable. Part of the actions taken during Q1 and Q2 is to adjust the health organization to reflect the migration to a less capital-intensive business model. These actions are taken and will lower the operational cost base of the health organizations in the periods to come. And of course, we will also continue to seek efficiency in what we do in this business area also moving forward. Finally, at the end of health and my part of the presentation, a few words about the other value proposition within the health business area, Salmosan or Purisan, which is the brand in Chile, who keeps on getting new life as a very efficacious solution, also in combination and complementary to Ectosan Vet. Sales of the medicine have continued to develop well in the region. We see that also in Q2. Our belief in the Salmosan solution has grown over the last years, and it continues to grow as we see new regions coming in with an obvious need in the years to come. So, with these words, I end my part of the presentation and leave it up to you, Septima, to take them through the financial more granular.
Thank you, Trond. So, as you can see, we have both the quarterly and the half-yearly figures here. I'm going to speak to the quarterly progress, but it should be noted that when viewing the half-year numbers, that last year included a very, very strong Q1, which has normalized in financial year 24, and Trond touched on that earlier. So during Q2, we've also had significant FX headwinds, as can be seen in the differences between the actual and the constant exchange rates all through the lines of our income statement. At a revenue level, we were slightly behind last year by 3% at constant exchange rate. This was driven pleasingly by revenue growth in nutrition and genetics of 3% and 7% respectively, which was then offset by the health revenue drop, which fell by 35% as we had less PSVs on the water in this quarter versus the same quarter of last year. From a gross profit perspective, it fell to 20.9 million. Part of this was, of course, the FX headwinds, driving 1.5 million of the drop. Nutrition also had a slight product mix effect, which reduced gross profit by 0.5 million pounds, but the majority of the shift, 1.4 million, relates to health due to the lower activity levels. When we look at genetics, excluding the fair value movement, genetics gross profit grew by 0.4 million, but including it, it fell by 0.6 million pounds in the period. And that is due to the non-cash fair value movement on biological assets. Looking at R&D, it continues to be flat in the period versus last year, but it's actually a tale of two stories. We've continued to invest in our new initiatives, and Trond spoke to some of them earlier, but we've also internalized some of the programs, and so therefore we have been able to get better cost efficiency within that spend, and we hope that this will continue as we progress through the year. Looking at other operation costs, they're significantly lower than the same quarter of the previous year, down by 16% at constant exchange rate to the 9.9 million pounds. This is due to two main areas. Nutrition has maintained very, very good cost control whilst dealing with difficult markets. And also, as Trond noted, having taken out the first PSV, we have right-sized the health organisation to reflect that move towards the barge model and thus taking down our operation cost exposure. All of the above drove adjusted EBITDA, excluding the non-cash fair value uplift, to grow by 9% at constant exchange rate in the period. And also resulted in an adjusted EBITDA margin, excluding the fair value uplift, of 25%, as Trond noted, our target margin for the business. During the period, we did incur exceptionals of £2 million, mainly related to the spend associated with the strategic review process, which is currently underway. But we also had some costs associated with the restructuring within the businesses as we right-size the businesses for the future. Looking at our net finance cost, it's driven in the main by the debt and lease interest costs of 2.6 million, which is then offset by FX gains and fair value movements on the hedges that we have associated with our debt, resulting in the charge that we see in front of 2.3 million in the quarter. All of these factors drove the loss before tax to shrink from 1.7 million to 0.7 million in the quarter. Then moving on to look at the next slide. We're going to look at the cash flow for the quarter, and then after that, we're going to actually look at the cash flow for the year to date. Everybody knows I do like my cash flows. When we look at it from a quarterly point of view, we have quarter two is generally quite a cash generative quarter. And it has cash generated from operations of 6.1 million after movements in working capital. When we look at our CapEx in the quarter and also in the year has been very low at 0.8, as we generally have low CapEx activity levels during the period. In the quarter, we paid 4.7 million for interest and taxes, 2.2 million relating to servicing our debt and leases, and 2.5 million in taxes. Just to refresh your memory, we pay taxes in the profit-making territories that we trade in, mainly Norway, Iceland, and Belgium, our main tax-paying countries. And of course, we had an outflow associated with our leases of £1.5 million. Additionally, as we now have given notice on the last PSV, this will also result in our net debt figure reducing by over £4 million, as we will no longer have this lease liability. And we're going to see the effect of this when we report our quarter three results. And finally, the positive effect from FX of 2.8 million in the period, all contributing to our net debt at the 31st of March of £72.7 million. If we can move on to the next page, just to quickly have a look at the year-to-date cash flow. As you can see, we had in the half year, we had lower cash generated from operations in the half year. This was driven in the main by a quarter one investment within our working capital, driven by the payments we make on our Take Or Pay Artemia contract. Just to refresh everybody's memory, we have 3 payments on that contract on an annual basis. 2 of them are in quarter one, and the third payment is in June of this year. So we'll see it come through in quarter three. As I noted earlier, we have had very moderate capital expenditure in the period, and I expect that that's going to continue through the year. When we look at the overall cash and interest point of view, we had 4.2 million of payments for interest, including, of course, the lease interest, which will then fall away as we move away from the PSVs, and 3.7 million for taxes. But all in all, when we look at our cash position and our balance sheet, we're at the end of the quarter two, we had cash of 20.8 million pounds and available liquidity of 40.5. We've now increased that headroom. So now we have 24 million of cash and available liquidity of 41 million as at the 20th of May 24. All this means that we've got a very good and strong financial position as we continue to move the business forward. So back to you, Trond.
Thank you, Septima. And let's now move on to say a few words about the outlook for the rest of the year. In short, this is also in line with what I said initially. We are trading in line with our expectations for the year. We are on track to deliver the year according to what we have expected and has been communicating. We are in a very busy year, and we intend to continue our effort to make sure that we take out the potential of the group as well as the different parts of it. In genetics, we keep good visibility of salmon egg deliveries for the full year. As stated, we do not expect the ISA incident that happened early in Q2 to impact our delivery capability for a full year. That will be normalized without the extraordinary effect that we saw back in Q4 in 2022 and in Q1 last year. We keep our work to develop our growth vectors in Chile, where we have had significant advancement this quarter, and on shrimp, with a clear aim to make these growth vectors sustainable profitably over time. For the year, we are tracking in line with our expectations for both those growth vectors. For genetic services, we expect we will see continue to grow, even though from a low starting base. In advanced nutrition, we still expect to continue to do well in what is a soft market. We do not bet on the market suddenly turning, rather focusing on making the utmost of the market that is there. This has been a recipe that has shown very effective over the last year, and we continue with the same recipe also going forward. Then we are very sure that we are very strongly positioned when the market again turns, and the market will turn. In health, focus is on migrating to the new business model for over the year. Again, focus will be on cost to keep them as low as sensible in this transition period. On the second value proposition on health, Salmosan Purisan, we expect sales to continue for those as it has done also for the remaining of the year. And with those words, I think we are ending our presentation. And Hannah, we are open for some questions.
Thank you very much. What revenue growth do you see for Chile and shrimp market in genetics?
Chile, we, Septima, relate to numbers. If you could probably be even more precise to me on that, and then I can add more dimensions on that afterwards.
Well, I think it's more about bringing it back to the dynamics in terms of Chile. We have capacity, invested capacity of 50 million eggs, and over the coming years, we will be able to exploit that capacity. Now, the average selling price of a salmon egg in Chile is slightly higher than in Europe. So that sort of represents, good revenue potential for the future.
Trond, did you want to add a little?
No. I think that's precise enough, and that's how precise you can be. It's in Chile, both Chile and what we do in shrimp it's important to understand it's an incremental development where we have done the groundwork in both areas. And for instance, when it comes to Chile now, we see that we are 2 years ago we didn't have any customers. Now we are in and talking and having starting business with 9 out of 14 players in the Chilean market, because we have done the groundwork in terms of infrastructure, in terms of genetics, in terms of the organization. So it will be an incremental development over time in order to take out the capacities that Septima mentioned in that market over the coming years. In shrimp, it's a little bit the same thing. We've done a considerable change in the strategy when it comes to shrimp, with tying what we're doing on the genetic side more closely to the enormous, very well developed distribution efforts that we have in advanced nutrition. We are still in an early stage of that. What you can see in the numbers so far is basically that we have been able to reduce the cost base, which is always important enough. Over time, we see an incremental development of the sales with the new business model.
Thank you. Okay, let's stick with Chile. And just you mentioned in the statement and in the presentation today about the green shoots that you were seeing there. Can you expand on what's going on to give you that confidence and what sort of time frame you are hoping to be looking at?
Well, the green shoots we see is in advanced nutrition, which has been a very soft market, and that's and that relates to the shrimp markets we are in, or the shrimp production regions that we are in. We see and have done that for a while, some recovery in part of that market, but it's more like blinks. And so we don't consider it as being, a very stable recovery as we are expecting will come at some point. The point of mentioning it is that, we partly behind the explanation of why we are doing so well in such a soft market is that we are agile enough and we are in position to take advantage when these green shots are occurring. So that's one of the points. But we are not in a position to say that the shrimp market is no recovery. Rather, our focus is to do well in a soft market, and that's the recipe that we have had over the last year. Has worked well, and this is Benchmark, and we'll continue to do that. And then we will be extremely well positioned when the market again gets normalized and we get an upturn.
Okay,
More
thank
consistent
you. On health and the PSV, we've unwound them, but which other markets are you hoping you could take the barge format into, and what sort of time frame are you hoping that you can roll this out in?
We are talking about the coming years, some nearer term, some longer term, but we see obvious potential for this in Canada, East. We see obvious potential for this, of course, in Chile. And to be honest, both those markets would not have been applicable with a PSV solution as we see it now. They need a different configuration that is more tailored to what they need. There are smaller farming regions, so that the barge solution could open up. But these two markets are probably the nearest. You also have markets like Iceland, which is now coming up, and they have plenty of sea lice, and Faroe Island that could be on that list. And we are working with contacts into all these markets to see opportunities and see what kind of right timing it is to enter into this kind of market.
Okay, thank you. Lastly, the ISA incident. Have you seen this impact on customer confidence more broadly? And
I'm very glad to say no. And this is because one thing is to handle the ISA incident from a technical point of view, make sure that you limit the damage when such an incident happens, which has been very successful. But one of the things that we were afraid of, to be honest, was, because it has been a stigma around ISA always. We were afraid that we will lose customers. We have not lost one customer. We have not lost one customer. It speaks very well to one key element in our strategy, and it's not only in genetics, but all over Benchmark. We are close to our customers. Important part of our strategy is to form very trusted long-term relationships with our customers, and this is now paying off. Even I have to say that sometimes both me, but especially Septima, says that do we need all this effort in the market, but in such an incident, I think it really has paid off because they trust us and they are sticking with us.
Well, and proof to everyone else as well that what you say is also what happens on the ground. So good to hear. Well, that is it for the questions today. So thank you to you both for your time, for our viewers for listening in, and we look forward to more updates in the next quarter.
Thank you. Thank you all for listening. Okay, bye now.